Welcome to the deep dive video update. This is a video that I do every week, and my context of deep dive is different than maybe you're used to. I look at hundreds of charts every day, and some of those charts I use in the daily and weekly videos that I do. Those charts that I don't use, I put them in this video, and there are also some additional charts that only apply to this video. It's kind of a catch-all. Sometimes we can get some clues and some insight as to what's happening in the market, not only by what we're watching and showing in the other videos, but by what we see in this video itself. This is being prepared for Monday, November 11th. There's a thing called the SPX Investing Program. It's a program I have developed. It's free until the end of 2024. If you're interested in that, please feel free to check that out. There's a link below this video that will take you to the website and to a video that talks more about the program. If you have any questions, you are more than welcome to send me an email. I also do a number of different videos, as I mentioned. The deep dive is just one of the videos. The daily video is the real foundation of the analysis and commentary that I provide. But my videos are longer and I show a lot of charts there. Some of you may not have a lot of time to watch that. Actually, it would probably be to your benefit to go to the website because I do another video that only members can see where I really break things down in a much quicker fashion. Okay, the first chart that we look at is the VIX, and this is a 50-period moving average on top of the VIX, and then I turn the VIX invisible. This just gives us the overall range over a long period of time. Now, the VIX had been quite high leading up to the election. Now that we're really going up with the S&P, the VIX is dropping down. That's not picked up really on this chart. What we're looking at are the longer term ranges of the VIX, where we have been going up as the market was getting a little tense ahead of the election, but overall we have dropped down into a lower range. We don't make any decisions based on this chart. This is mainly just for informational purposes and to give us a bigger picture of the VIX. Also, this has kind of been coming and going out of some of the videos. There's a VIX to S&P 500 correlation that's shown right here in the middle. And when we get up above this dashed line, that means the market is getting nervous. And we were up there for a while. But since that time, we're coming back down and getting very low readings as the S&P has been going up and the VIX has been going down. We also look at the VIX and then the VVIX, which is the volatility of the VIX, like an indicator of the VIX. And then we do a ratio between the two just to see if this is giving us any insight. For the most part, it's been going up lately. That just means that the VIX is moving faster than the VIX of the VIX is. And that can be somewhat negative. Typically, when we see this going down, that tends to be more positive for stocks. But then when we start going down here, you can see, it doesn't mean that we're going to go up with a lot of magnitude, but we were going higher. And then in 2022, when we were really in a bear market here, this ratio was really going up. So this is kind of going against what we're seeing, but this could be an awful lot of hedging around the election. We'll see if this ratio starts to drop after the results are final and everything moves forward after the election. We look at the VIX, which measures the volatility of stocks. We also look at the MOVE index, which measures the volatility of bonds. And we're coming down. I mainly follow the moving average. We're coming down right now. And interest rates have been going back up. And that means that price of bonds are going up. And that means the MOVE index is going up. And that's why we were seeing a decline here. We also were getting very high readings with the VIX. Now that things are somewhat settled down, of course, anything can happen to change that. But maybe this will mean that volatility is actually slowing down a little bit, which means bond prices can continue to go up and stock prices may continue to go up, but we'll just have to see how that plays out. Then we look at a risk on versus risk off ratio. And I usually show this in pretty much every video, but we've just been chopping around now as the market's been rather indecisive. If we really are turning back and looking more positive, we'll want to see this ratio going up, meaning folks are getting into the risk on stocks instead of risk off, which are the more defensive type stocks. So since we haven't really shown a lot of conviction in this chart, I haven't been showing this in the videos. And then we look at the ratio between large caps and small caps. really coming down here as we saw small caps doing better. That's what happens when this ratio goes down. When this goes up, that means large caps are outperforming. And we're wondering, the small caps are looking better. In fact, when we get to that part, it's the best looking chart right now. But we've been fooled before, almost for about a year. And I say we by meaning the market. I personally don't do anything with the small caps other than just observe them, but they broke out about a year ago and then fell back. Then they broke out two or three times throughout 2024, only to fall back. Is this one for real? Is now that the election is over and the market likes how the election turned out, and they don't really care one way or the other, but they like some of the things that could be more pro business that are going to be attempted during the next administration, and that could end up helping small caps. There's also some things. I was just listening to something before I recorded this. An economist, Jim Rickards, who is just coming out with a new book this week, talking more about AI and the economic ramifications of that. Well, he also thinks that after the election, there may be a recession that we go into. Now, we look at charts all the time that talk about, yes, we could go into a recession, but we see a lot of charts too that say, no, we won't. So it's a debated topic. It's been debated now for the last 2 or 3 years. It's pretty much always debated at some point or another. If that ends up happening, that could do some damage to small caps because they need borrowed money. They need a lower interest rate environment, which they'll get in a recession sometimes. But the the slowdown of the economy could really hurt them as well and bite into their earnings. So we're watching this just to see, are we going to see a real shift in the overall trend of this chart here? So far, we haven't. We'll have to see if there's any follow through with this. Then, where are we in relation to the previous all-time high that was set in early January 2022? As of Friday's close, we are 24.42% above that previous all-time high. And this is too hard to read here. Mainly what I'm focusing on when I show this chart are the colors. Down days, we see a lot of red. Up days, we see blue or green here. And some of the more defensive areas, we're seeing some weakness even as the market was going up. And some of the more growth areas, they were turning more positive, and we had the S&P, the Dow, the mid caps, even the small caps setting highs over the past week. And so a lot of positive things ended up happening. Now, this is the technical score that I talked about. We're in first place. We're now seeing for the first time in a very long time the small caps. This is the IWM, the Russell 2000 small cap ETF. It's coming in first place, and it's into the 90s now, where it's been languishing down in the 40s. And if you go back even over the summer, we were getting down into the teens with this chart. This only goes back a few months here. But as of Friday's close, the small caps are looking pretty strong. But they've looked strong before, only to fool the market and end up giving back a lot of those gains. So, once bitten, twice shy kind of a thing there. But maybe things are really changing to help the small caps. They were the one languishing area as we've been coming up out of the lows that were set back in October 2022. Then in second place are the QQQs. Now, these are the big stocks, the NASDAQ 100, the NVIDIAs, the Googles, the Apple, the Microsoft. This is looking pretty good. Not quite as strong, but coming in second place at 85.1. The SPY, which is the S&P 500 ETF, still looking good. Now, there's 503 stocks that make up this index. It doesn't necessarily always outperform when we're in a strong market, but it tends to hold up better in environments when the large caps and the big stocks are slowing down. That's what we were seeing up until just this past week. The SPY was actually doing better and outperforming the NASDAQ 100 and even the NASDAQ. Is that going to shift now? And this that is more diversified with the different stocks that make up this index, is it going to start to underperform a little bit if we get into a high growth type of an environment? Mid caps coming in at 74.6. Also, they were looking really strong earlier in the year. There's a number of times I would do this video and they were in first place. Then they started to drift off. They're doing better, and we're setting all-time highs with the mid caps, but it doesn't look as strong technically. And then in last place, coming off of an all-time high, is the Dow coming in at 72.6. So we're seeing a little bit of shifting around. We'll see if this can last, but everything is pretty much doing good right now. The lowest score is 72.6. When you get everything above 70, of course, you want to be into the high 80s or even into the 90s to show a real strong chart. But even when your weakest chart is in the 70s, it suggests the market is looking pretty good. Okay, then we have a short-term rainbow going from 10 periods up to 50 periods using simple moving averages. We had fallen down and come to the bottom end of the rainbow. We were starting to battle with the 50-day moving average. That held as support, and then the election came, and we were able to shoot up out of that. So the short-term trend has turned back to more decisively positive. Intermediate term, a rainbow going from 50 periods up to 100 periods. We were coming down into the top end of the rainbow. That's the 50-period moving average. Then we bounced up above that. So the lines continue to go up. And if we stay above this for any length of time, these lines will even smooth out more than what they already have. The 50-period moving average, we were really focusing on this just a week ago. This was one of the main charts I was looking at, but since we bounced up off of the 50-day moving average, I stopped showing this in the daily videos. Unless we start to come back down, I won't keep showing this chart. And then the same thing with the 100-period moving average. I never did start showing this because the 50-period moving average is held. But until we see some weakness, this is still looking pretty solid with both lines going up, and we're well above both lines. The mass index is not generating a signal right now. We only pay attention to this if it gets up to the red dashed line and the blue line, but we're far away, at least at this point. The Pring bottom fisher, we're going up, so this indicator is going down. And then I do show this in a different way in the daily video. It's the advanced decline ratio, and this is short term based on 19 days. But the chart that I show is only based on price. This breaks it out with price on top, and we're above zero. And this also includes volume, which is not shown in the other chart that I usually do show. And we're above zero here. So we're looking quite positive on the short term with this. And then this is a broad market measure with the Amex, NASDAQ, and NYSE, and we take a 5-period moving average of the highs minus the lows. We were coming down. We were in danger of actually going negative here, but with the strength that we've seen since the election, this is really starting to go back up and just showing broad market strength. And this is based on the S&P 500, but it's also intermediate to even a little bit long term. This is a 10-day average of the highs minus the lows. And we were really extreme for quite a while. Then we started to see some weakness and we dropped down below this green line. And as long as we stay below the green line, I won't show this. If we go back up above that, that means good, solid, long, even intermediate to long-term momentum. And then I'll be including this chart again. And how far away are we from the 200-day moving average? Now, a lot of times this is just for informational purposes, but we're up over 11% above the 200-day moving average. If you notice back here, when we started to run into some trouble last spring, and then we hit a high back in the summer in July, and then we saw a decline after that, we were about around the 15% distance from the 200-day moving average. And that can mean we're getting a little toppy at that point. Now we're over 11% now, so we still have 4% to go. But if we get back up, if we keep going higher and we get up around this 15% level, then we're going to be watching this a little closely with a bit of a different context. Then going back to a year ago when we set the low in October 2023, and then based on Friday's close, we are up 31.5% from that low just a year ago. And this is not going all the way back to the low set in October 2022. This is the low October 2023. So that's not including these gains. And you can see here, I still have it marked where we hit the high in July and then we started to decline. When we were getting to that decline of 10%, well, first it started because we were getting far away from the 200-day moving average. And plus we were overbought and we were looking overextended at that time. And then we really started to come down. If we hit some kind of a top and then decline, if we fall down around 10%, we'll be looking at that as possibly being support. That's what happened back in August. This was that big downtime that when everybody thought the world was coming to an end. We got close to that 10% level. The smart money saw that. They saw, okay, we're 10% off the highs. We're going to come in and start buying. Boom, and kicked us up back higher. Now, we don't see necessarily that scenario unfolding right now, but we're just kind of watching for that to see if it develops. Connor's RSI is another oscillator that I use to determine extreme positive or negative readings. We got a little close here when we had that big update on Thursday, but we didn't quite get to an extreme reading. And then anchored moving averages, since we've been going up for the most part, the more we go up, I may end up drawing another anchored moving average from here because these go forward, where typically moving averages go backwards and use historical data to calculate. We'll be seeing if some of these areas end up providing some kind of support if we do see a pullback. Looking at the S&P 100, which seems to be matching up pretty well right now with the S&P 500, and the 100, those are the biggest stocks that make up the S&P 500. Then a long-term rainbow going from 50 periods up to 250 periods. We never really were in danger of seeing the long-term trend turn negative. We came down to the 50-day moving average, and then we've been able to bounce up off of that. So all of these lines are pretty much flat. They're not, the distance between them is good, and their spacing is kind of far apart here. They're not flat, they're going up, but there's just showing that the long-term trend is still comfortably intact. Then a long-term oscillator that we use is the daily version of the special K chart. And we're still positive here. Now I don't have it on here, but the weekly version of this is just getting ready potentially to cross positive. And we've been waiting for about a year, not even longer, for the long-term chart to turn positive. This has turned positive. It was bouncing around a little bit in 2023, but since it finally crossed over about a year ago, it's been positive ever since then. Then we look at a weekly chart of the S&P on top and a weekly chart of the German DAX on the middle area. And you can see that there's a pretty strong correlation between the two. Now, the US is treating the election results as positive. Based on the things that I've been seeing, Europe's not real happy about things because it's not what they expected to have happen. So we'll have to see if there's going to be a disconnect between how the markets behave in Europe based on how they're behaving in the US. Then I was showing this for a while. This is a 20-period simple moving average of the open, high, low, close. We had actually fallen down below this little mini rainbow here, but then we were able to recapture that, and the lines are going back up. As long as we stay above these lines, I won't be showing this chart in the videos. Fibonacci retracement levels, we did set a new all-time high, at least on an intraday basis and on a closing basis in Friday's session. So I've redrawn these a little bit here. If we do really start to decline, we'll be watching some of these fib retracement levels, but we're, of course, quite far away from them right now. The VIX is what measures the volatility of the S&P 500. The VIXN measures the volatility of the NASDAQ 100. It had been getting quite high too, but since has been dropping off as we're seeing the NASDAQ 100 improve. And then we do the S&P 500 on top, and then a ratio between the Qs, which is NASDAQ 100, and the diamonds, which are more the blue chip stocks, more value stocks. And there's not really that big of a correlation between the middle chart and the top chart right now. We'll wait to see if that gets a little stronger or weaker. We look at the QQQs. Now, I was showing this a while ago because we had gone below the 20-day moving average. Well, we were able to recapture that, and as long as we stay above the 20-day moving average, we're still positive. The transports, which finally are breaking out and doing something kind of good, but the Dow is setting all-time highs as well. So both of these are going up now. The bank ETF, it really spiked up, but then we're seeing a little bit of a pullback right now, but this is still looking quite positive. The regional bank ETF, the smaller banks compared to the financial sector, also showing some improvement right now, but we'll want to see if they can break out more to the upside here. And then I have some long-term rate of change charts going back 250 periods. These are still looking quite positive. And then another chart, we're above this blue line and looking positive here as well. And then looking at cash, which is 1 to 3 month T-bills, and then comparing it with 3 to 7 year bonds, this is going up, which usually would mean, okay, they're worried about inflation. And the market may switch back to being concerned about inflation because it may be more of a pro-growth environment. And we may see interest rates go up because of that. And it may be that inflation does go up. And that could be for good economic reasons. We want to see if there can be a balance between growth, but not too much growth, and weakness and not too much weakness. And so we've been kind of seeing this ratio going back up, but the context has changed a little bit, at least to right now. Where when this was going up, there were inflation fears, there were interest rates were going up. Now this is going up. The Fed just cut rates again this past week. Now we have been going up with the other government bonds like the 10-year yield, but are they going up in anticipation of economic growth? That's what we're trying to unveil here and see in the bigger picture if that's how things are developing. Okay, then we look at the long-term bond ETF, which is in blue, and the S&P, which is in red. The long-term correlation between the two, not all that strong. Seeing a little bit of an improvement here with the shorter-term correlation. And then we do that same thing with the Qs here in black, and then the long-term bond ETF, which on this chart is in red. They're really going in opposite directions right now. We've been seeing the QQQs going up and the long-term bond ETF. It's going up as well, but has really been underperforming. And then we take the 10-year yield and subtract the German 10-year yield. That gives us a positive answer. And we see that there's a pretty strong correlation between the top chart and the dollar index as measured by the correlation down below. So this just kind of shows us the interplay between interest rates and currencies. And we're keeping an eye on the 2-year Treasury yield, which had been coming down. That was giving some support to the S&P. Well, now it's been going back up. Is that going to put some pressure on the S&P? And here's the 10 to the 2-year yield curve here, which is no longer inverted. I mention it in every daily video. This is where I actually show that chart. And we're getting close, but we're still inverted here with the 10 to the 3-month yield curve. And looking at this oscillator here, these are stocks above their 200-day moving averages in the S&P. We're above 50. We're not showing an extreme positive or negative reading right now. So we're not really getting any additional insight from this chart. Then how about those stocks above their 50-day moving average? Also really improving, but not getting an extreme reading right now. Improving with the mid caps and also improving here with the small caps. So thank you. I hope you found this helpful. Have a great weekend, and I will talk to you in the next video.